Good morning and welcome. This is Business Morning on Channels Television. I'm Chimeze Obi Iwago.
And I'm Ladi Williams. We begin on the global scene with oil market update. Oil prices climbed this morning after industrial data showed U.S. crude stockpiles fell unexpectedly last week. And China, the world's second biggest oil user, reported its lowest daily rise in COVID-19 cases, bolstering hopes of a pickup in demand. Brent crude futures climbed 19 cents to $56.10 a barrel, adding a small gain on Tuesday. And U.S. West Texas Intermediate crude futures rose 20 cents to $52.81 a barrel, reversing Tuesday's loss. The American Petroleum Institute reported crude oil inventories in the United States, the world's biggest oil consumer, fell by 5.3 million barrels in the week to January, compared with the analysts' expectations for a build of 430,000 barrels. However, the data showed gasoline stocks rose by 3.1 million barrels, which was much more than expected. Still, prices were supported by easing worries about a sharp drop in travel over the Lunar New Year in China, the world's largest oil importer, as the number of COVID-19 cases appear to be declining.
In the meantime, the International Monetary Fund has raised its global economic growth projection for 2021. This is coming a day after the United Nations released a similar positive forecast in its World Economic Situation and Prospects report. In its latest World Economic Outlook, the IMF put global growth estimate for the year at 5.5%, which is slightly higher than the 5.2% it forecasts made in October last year. However, the International Financial Institution warns that the world economy may continue to face exceptional uncertainty as close to 90 million people are likely to fall below the extreme poverty this year.
And back here, the Lagos Chamber of Commerce and Industry says it expects Nigeria's economy to return to growth path in the second quarter of 2021 at about 1%. The president of the chamber, Mrs. Toki Mabogunje, while giving reasons for the growth projection, as that the recovery will remain subdued, the fiscal and monetary authorities fail to push coordinated policies aimed at promoting growth. Do take a listen.
The country's recovery prospects in the year 2021 will be dependent on four key factors, which are: A, effective management of the pandemic locally and globally; B, widespread vaccine rollout; C, direction of global oil market; and D, quality of fiscal, monetary, trade, and regulatory policies. Accelerating the pace of economic recovery requires fiscal and monetary authorities to be well coordinated to promote growth-enhancing and confidence-building policies that would encourage more private capital inflows into the economy. An investment-led growth strategy is critical. We would like these measures to be sustained in the year 2021.
Interestingly, the Monetary Policy Committee of the Central Bank of Nigeria concluded its first rate-setting meeting for the year yesterday, opting to leave all policy parameters unchanged. The policy decisions reached are as follows. The benchmark interest rate retained at 11.50%. The asymmetric corridor remained at plus 100, minus 700 basis points around the MPR. The cash reserve ratio retained at 27.50%, and the liquidity ratio retained at 30%. The Central Bank Governor Godwin Mayfield reeled out some of the basic considerations before the committee reached its conclusion. Let's take a listen.
In the committee's consideration, it noted that COVID-19 pandemic and the necessary measures put in place by the government to forestall its public health impact, such as the lockdown and other associated restrictions, contributed to the Nigerian economy going into recession, unfortunately, much like almost every other country in the world. Members reiterated the adverse impact of insecurity on food production, stressing that the current uptick in inflationary pressure could not be solely associated to monetary factors, but due mainly to legacy structural factors in the economy, including major supply bottlenecks across the country. The committee thus called on the government to redouble its efforts at strengthening infrastructural efficiency and address the emerging security challenges in the country. In addition to this, the committee called on the government to explore the option of effective partnership with the private sector to improve funding sources necessary to address the huge infrastructural financing deficit. The committee expressed concern over the rising public debt stock as recurrent expenditure remain relatively high compared with capital expenditure, thus signaling future debt servicing challenges. To improve government revenue sources and investment in capital, the committee called on the government to take advantage of the takeoff of the African Continental Free Trade Area, AfCFTA, which could boost domestic production and generate sizable revenues for government, as well as providing domestic productivity and competitiveness. The committee commended the bank's efforts in improving liquidity in the foreign exchange market, but noted the need to continue to explore avenues to improve inflow from sources such as through the international money transfer operators, diaspora remittances, and non-oil export promotion. Given the current trajectory of crude oil prices, these sources, in the view of the committee, would boost foreign exchange supply and ease the current exchange rate pressure. The committee noted the continued improvement in the equities market as a lead indicator of medium-term macroeconomic recovery, thus urging the bank to maintain its collaboration with the fiscal authorities to improve the investment climate towards attracting sustainable foreign direct investment. The committee commended the bank for maintaining a sound regulatory surveillance over the banking system by ensuring a reasonably low level of NPL, non-performing loans, even with the aggressive credit expansion program during this crisis period. Though NPLs remain slightly above the prudential benchmark, members noted that the banking system remained stable, strong, and resilient. Given the success recorded under the loan-to-deposit ratio policy, it thus urged the bank to sustain its risk surveillance approach and ensure the continued soundness of the banking system. In the committee's consideration, it noted the broad-based global stimulus packages, including expanded credit lines, asset purchase programs, corporate bond purchases, additional funding facilities for financial system, commercial paper purchases, special central bank lending, increase in the ways and means limits introduced by the central banks all across the world and in different countries to support economic recovery in their various economies and to prevent further distortions to the economy caused by the devastating impact of this pandemic. The committee noted the large stimulus packages deployed by many countries to fast-track growth recovery and restore livelihoods across the world. For instance, Japan provided stimulus package valued at 66.9% of its 2019 GDP. UK, 45.04% of its 2019 GDP. United States of America, 28.4%. Brazil, 27.6%. South Africa, 12.6%. China, 11.5%. India, 10%. Russia, 7%. But Nigeria, paltry 4.5%. The MPC therefore urged the bank to further expand its current stimulus packages to support fiscal interventions to reflate and boost recovery in the economy.
And that was the Central Bank Governor, Mr. Godwin Mayfield, at the MPC meeting. Joining us now is a financial management consultant and CEO of Flame Academy and Consulting. Thank you for joining us, Mr. Orji remains where?
Good morning,
Good
Mr.
morning.
Dede.
Morning. Always my
nice
pleasure.
to see you.
Yeah, my pleasure.
Happy
having
New
me.
Year. We're seeing
Happy New Year.
this year.
We're hoping that 2021 will be a better year for all of us.
Exactly. Well, I guess in the case of the MPC caught between the devil and the deep blue sea at this point. But what do you make of the option they've taken?
Well, it's just the option of sit down the look. Let's just watch as things go. Because the whole essence of monetary policy, obviously, is to manage the quantity of money in supply in the economy. All right? Because the argument theoretically is that when there's so much money in circulation, there's a lot of money we're pursuing few goods and therefore driving prices up. So the primary duty of central banks all over the world is to maintain monetary stability, ensuring that price increases in the economy do not go at a hyper rate. That's seeing inflation like in Nigeria having a double digit and beyond that, because that damages productivity. So you find that the Central Bank of Nigeria is in a very big dilemma because ordinarily, because if you look at their objective of maintaining price stability, we are losing it because prices are still going up and up. Theoretically, we say that inflation today is about 16%, 15.75%. But actually in the market, most prices have gone more than 50%. The things you and I buy. So the duty of the central bank is to maintain this price stability. That's everywhere in the world. And to do that, looking at the way things are now, we expect that the central bank should be trying to curb inflation by doing what you may call some monetary policy contraction. Trying to apply contractionary measures, i.e. trying to raise rates. When they raise rates, for example, what will happen is that there's so much rush for money market instruments. Banks will not be able to lend out more money. People will not be able to borrow at higher rate, and therefore you mop up the money in circulation, and therefore slow down inflationary pressures. If that's what we should be looking at right now. But if they do that, trust me, it's going to be very counterproductive because already the economy is in deep trouble with COVID and all of that. So at this point, no reasonable central bank will be looking at increase in rates. Instead, everywhere in the world, they're looking at monetary easing, or what you may call expansionary monetary policy, whereby rates are brought down to enable the real sector of the economy to be able to borrow at reasonable rate, drive production, and be able to reverse, as it is now, an economy in recession.
Now, you just talked about the key issue here being inflation. Now, the question is, what exactly is driving this inflation? Yes, we'll talk about some of the issues we had, security issues and flood issues and all of that. But then you did mention money supply. And if we listened to the central bank governor, he talked about the committee, expressing concern over the rising public debt stock. Don't you think that perhaps increasing the rate at this time would help control the level of federal government debt funded by the CBN, which according to Fitch is also stoking inflation there? Because, if people are unable to save, then you find out that people end up spending more. Okay, and then people are not saving, so the government don't even have the money.
No, now let's get it right.
to
Nigerian economy is a very peculiar economy. Many times it tends to run counter to most established economic theories and even practices. Elsewhere in the world, there are no major issues about inflation because the domestic demand is at its lowest level. Travels are restricted. The COVID lockdown has made people, jobs are being lost. So, theoretically, people don't have money to spend. And in most economies, particularly in the Western, economies, you find that aggregate demand is actually, on a decline. And therefore, purchases are not going up as they should be. So inflation is actually low in those places. But in most of emerging markets and developing economies like Nigeria, the argument is different because, like in Nigeria, the bulk of the factors driving inflation, is not demand pool. It's not about you and I having so much money in our pocket, demanding for having greater command for commodities. But what happens here is that our inflation flows really, from FX pressure because one, we are not self-sustaining. Two, we import practically everything that we use in this economy. And because of the pressure on our FX, input costs, costs are huge. Our manufacturers locally here have to import their input materials, which are now at a, all-time high rate. And then the finished goods that we also import, that we use, domestic things and all of that, office equipment, furniture, and all of those things that we import too, are also coming at much higher rate because of the devaluation or depreciation of our currency. And what is causing this? That's where the problem is now. Until we address this issue of continuous depreciation of our currency, inflation can never be dealt with. That's why even at the time when all of us are not demanding much, when domestic demand is so low, we still see inflation climbing off the roof, particularly food inflation and similar factors.
Okay, looking at the CBN governor's reaction to the Fitch report, he said it's not unusual for the central bank to support the government. What's your take on that?
Okay, that's the ways and means methods. It's actually not very usual all the same. But it's not abnormal to do that. India is the foremost country in the world that's known to have started using that about 2-3 years ago. Nigeria is following through. So I disagree with central bank to say it's a common thing everywhere in the world. No, it's not. India does it. Nigeria does it. A few other countries do it, but it's not very normal. Ways and means is actually a way of saying the central bank is using the reserve they have, particularly in this era of very high reserve, that central bank mops up from commercial banking or deposit money banks, where CRI is currently at 7.5, and other reserves that they have in the system to lend directly to the federal government. Ways and means method. In some extreme cases, central banks even actually print money to give to the federal government to deal with tightening or the dislocated cash inflow. Where federal government sees a lot of tight cash position where inflows are delaying. Revenue collections are delaying. Meanwhile, there are huge recurrent expenditure to run, particularly in Nigeria, where recurrent expenditure is a big problem for us. We run a very bogus government, that has to pay a lot in salaries. And every day this is happening. We have to service our debt about 3.3 or 3.5 trillion. Recurrent expenditure is, above 5-6 trillion for an economy that collects only about 4 trillion in actual revenue. So because of that cash squeeze, Central Bank has, in the past 2 years or so, been lending directly to the federal government, without issuing the necessary instrument. That's why the money market today is almost at zero. In fact, that policy is almost canceling the money market. And in a money market where rates are so low as it is today, banks are giving less than 2% for deposit. You find that people are no longer, incentivized to keep their money in the bank. Meanwhile, at that low rate, compared to high inflation rate, the impact is that there's very heavy deficit, negative real interest rate. So there's no incentive for anybody to, put their money in the bank. That's why both local investors and foreign investors are avoiding the money market today, and all the funds are moving, miraculously to the capital market. That's why you see a lot of activity in our capital market.
And that's what we're seeing there, do you see that causing some kind of bubble in the capital market?
It's a big problem because one day when that correction will happen, that whole bubble will burst as usual. So all the players must be careful. I'm not saying people should play, speculators will have their day, but the point is that we have to get it right, because the way we see it today, with a benchmark rate, 11.5% that was still maintained, with a corridor of 100 basis points
see
plus.
A lot of people moving again
so you find that with that, what does that mean? In Nigeria today, benchmark interest rate, which is not even realistic, is 11.5%. Inflation is about 16%. What does that tell you? Negative 5% real interest rate. So any foreign investor thinking about coming to Nigeria will not come, because they will achieve in a 1 year period a net loss in their funding. And what does that do to our FX liquidity? It nails it off, because foreign investors, portfolio investors particularly, like to push in a lot of dollars to take position in our money market instrument. And when they do that, it improves our FX liquidity and help manage the pressure on our. But that cannot happen today. And again, it may be good to say that rates are low, because you see that low rate give rise to more lending by the banking sector to the real sector. But it doesn't happen because you also see the banks struggling with cost of running their business and very huge regulatory costs. For example,
the
CRR is 27.5%, meaning that for every 100 naira you bring into the system, CBN will seize 27.5 naira out of it. And again, you also have to keep 30% of that fund in liquid form. So at the end of the day, the cost of doing business, statutory costs and operational costs are very high. So, borrowers still end up borrowing at much higher rate than the real, deposit rates in the economy. So it's a big issue. And if I have a few minutes, I'll give you my policy suggestions to help manage this situation.
You will have the video. So just hold your thoughts there. We'll take a quick break, and then when we come back, we'll continue with this conversation. Welcome back. Well, Mr. Oji Demizwe is still here with us, and we're still looking at post-MPC decision. Well, Mr. Demizwe, before we went to leave, I wanted to get your take on this. What exactly is the nexus between inflation and interest rate. Is it possible for us to actually achieve low inflation rate and low interest rate?
Okay, in economic theory, interest rate is the price of money. Meaning that when there's so much money in circulation, interest rate will likely come down because there's so much money to give out, there's competition and all of that, it will drive interest rates down, all right, and vice versa. But when it comes to the relationship between interest rate and inflation, it becomes a very technical and very, cunning one. One is that when you have low interest rate, theoretically in economics, low interest rate will increase the impetus, for banks to give out loans. It makes funds cheaper in the economy and easier to be accessed by every person in the economy. Retail lending and all of that will happen more. Consumer lending will happen more. We'll tend to pick more televisions at the stores, go for more shopping at ShopRite and all of that. And theoretically, that's meant to drive up, demand and therefore possible inflationary pressure on the economy. So interest rate going low is likely to, drive inflation up and vice versa. When interest rate is high, and that's why when central banks generally around the world want to curtail inflation, they move interest rates high so that all the retail lenders, borrowers will find it's incentive to borrow. And people will tend to actually want to put their money in the banking system because high interest rate means higher yield on your deposit. So that way, the more pop liquidity, lending reduces, and then purchase of goods and services will drop, as in aggregate demand will drop, and therefore inflationary pressure will go down. So that relationship is actually an inverse relationship. But then, in an economy where things are normal, there must be an optimal level of interest rate that will help drive, lending to the real sector and and also other borrowings without actually causing high inflationary pressure. That's the work of the central bank. That's why they have to look at a number of issues as they drive their policy. In Nigeria, it doesn't seem to be working because even if you drop interest rate to zero today, yes, it's meant to drive inflation, but we will see that relationship because our own inflation, like I said earlier, is actually based on cost of both input materials and finished goods that we import mostly. And because we don't have enough accretion to external reserves to enable us to sustain a good level of pricing of our local currency, as long as this pressure on FX continues to happen, inflation goes up, whether you increase interest rates or you drop interest. So somehow our interest rate in Nigeria or inflation in Nigeria is, interest rate inelastic. If I put it that way.
Okay. So the committee noted the large stimulus packages from other countries, like the UK, for instance, having 45%, USA 28%, South Africa 12%, and Nigeria with a paltry
4%.
I have joked here without meaning any deriding anybody that Nigeria, itself as a country also needs palliative. They need stimulus. Of course, we've run quickly to the World Bank then, IMF, to get $3.4 billion from rapid, one of the windows that they have to give back to, special drawing rights and all of that to members. So, it's not funny, but but that's what it is. Nigeria is broke as a nation at this point. So, and whenever you have a serious distortion in an economy, like you have today globally with the COVID pandemic, nations, based on the, the neoclassical theories, that's the new thought that government must not stay idle. It must not stay apart. Like Keynesian economic thought that government must intervene when there's a distortion in the market to be able to rebalance things. So government is meant to push up money, monetary easing, quantitative easing, making money, asset purchase like the mentioned, and then direct lending, stimulus package, intervention funds to SMEs, agriculture, those who can drive economic growth. So in this country, what do we have? We're not even able to pay salaries. Talk less of being able to give out intervention funds to the economy. Now we've seen government announce a number of stimuli or stimulus packages here and there, to SME, to the health sector, aviation, and all of those, anchor borrowing funds, and all kinds, even the youth investment scheme that we always hear. These announcements happen on the pages of newspaper, on televisions, but in real, terms, I don't know if you know your cousins or friends or remote people that you can, if you do a random sampling, that will tell you we have been able to access these funds. So in my view, with all due respect to central bank, these funds are not, trickling down to the nooks and crannies of this economy. And until you do, the artisans, the market women who need these funds to drive their, because Nigeria is a hugely informal economy. The plumber, the mechanic, the bricklayer, the artisans, and the market women who need 50,000, 100,000 to drive their own economy, to drive their own business and recruit, pay one or two people in salaries or MSMEs basically. In fact, not even the medium. The micro businesses and small businesses are not seeing these funds. In my view, these funds are still being disbursed nearly politically. There's political connection or in a biased manner. So that's why I'm saying,
even if it's increased,
even if it's increased, you will see the impact on the economy. Do we have data to actually know who needs this money? Now we're beginning to ramp up on our data collection. Now you have to link your NIN to your phone. We already have other measures. Banks have done BVN. So if this country is smart, the central bank and the fiscal policy authorities must begin to work together with the telecoms industry, the banking sector, to harmonize our data to be able to know who is who in this economy, because even the poorest in this country now has a phone, and that phone number is now linked to the NIN. We can get detail about them. We can even link it to their bank to know how much they earn, so that these monies can go to the real poor who need this fund to drive their SME ideas. So if you ask me, if I can do that quickly, there are policy directions that must enable us to come out of this situation in the near term. Number one is that, like I've said, the disbursement of this intervention fund, if at all we have them, must be done in a very inclusive manner. The central bank, to me, does not have the staff capacity or the retail structure. Of course, central bank is not a retail bank. It's a mega bank. It's a banker to other banks. So I don't see the central bank being capable of driving sufficient disbursement of retail intervention funds to the real sector of the economy. So why wouldn't they work?
That's why the governor is calling on the banks to support.
Not just calling on them to support or bring their own money, but that fund that government has brought out as a fiscal intervention fund, how do we disburse them? Government must involve the microfinance institutions in this country, not just generally, but select the ones that have done well over the years. I don't want to call names there, but some of them we know, national microfinance institutions, statewide microfinance institutions. Select them in different states so that you can reach out to the real economy. Central bank are not in Abuja, where they have their major presence, or maybe in Lagos. Other states, they have minimal presence, they do operational activities. They can't tell us that they're sufficiently disbursing these funds in Calabar, in Sokoto, in Kebbi State, in Ebonyi State, and in Ekiti. Or even in Ogumosho. This cannot happen. They must, find a structure that will involve private sector, MFI institutions, microfinance institutions, to disburse this fund. That's number one. Number two, the central bank with the bankers committee must sit together and see how the commercial banking system and other, finance institutions can actually drive real sectorial. Even though we see, ramp up in the, general total credit to the economy by banks, coming to about 25 trillion. If you look at it, they are still happening in silos. The big names are getting more funds. The small names are still getting nothing. And I run a small business. I'm a consulting firm, so to speak. It's still as difficult to get a loan today as it has been over the years. Nothing has improved. So what policy can we put in place? How does government have a handshake with the financial institutions, through the bankers committee to decide the best ways, either it's, risk-sharing measures or whatever, to actually enable easy, and cheap funds get to the SMEs. That's very critical. And to improve that, comes to my number 3 recommendation. We must begin to ramp up, the drive to deepen data furnishing in our credit bureau system. In most developed economies, where, of course, growth is generated by investment, like Central Bank said, generated by SMEs, people borrow easily in the economy because their details are out there. How are we furnishing data to the credit bureau system? Are we doing that deliberately, where the Central Bank and Bankers Committee ensure that every bank, every institution that should provide data, whether it's Federal Mortgage Bank or AMCON or the commercial banks or even landlords, furnish data to the credit bureau so that all of us have, if I check Laddie William tomorrow, I'll say that, you borrowed somewhere, you paid your rent somewhere, and over the years, and you have a good record. You can get a loan easily, at least a minimum amount you can get. So banks do that today by profiling salary earners. And once you earn salary through them, they see your inflow, they give you 100,000, 500,000, without you even being involved in the process. Bureaus. I'm saying we have them, but we're not deliberately deepening data in that bureau. We need to, what we call data furnishing. We need to make sure that landlords must furnish data of those who are owing them. Microfinance institutions must furnish data of those who are owing them. Federal Mortgage Bank, AMCON, all of them, if they can furnish that bureau with enough data, all of us will have details there, and it's easier for me to borrow when you know that I've paid my landlord consistently. I have paid my mortgage loans to Federal Mortgage Bank. AMCON will say that people, that way we can solve this problem and be able to ramp up lending to the real sector of this economy. And lastly, for me, in my recommendation to the Central Bank today is that they must do something to handle this FX issue. It's a recurrent problem. We cannot run away from this hyperinflation until we fix our FX issue. And I keep saying it here, well, we keep running away from it. We must unify all the rates, one way or the other. Let me not say, because when you say, oh, they must devalue, people will start calling you a demon, and all of that. But we must find a way to unify the rate. And good enough, with the oil price ramping up now, the federal government is building their war chest better. We have a better accretion to external reserve right now. Let them not, like they have done over the years, waste that whole accretion, anymore. Over the years, we've seen the federal government trying to intervene, selling this money at a cheap rate and people around tripping it. Let them build that war chest, until we get to $45 billion, and then they will unify this rate. When you unify, it will cost a spike, quite all right. But with that money you have built up, you begin to intervene in a way that while the rate maintains the same level, you're able to manage its spike. So that when you unify this rate, you're able to attract all the foreign investment you can get, both direct investment and portfolio investment, and most importantly, you can drive export. Today, federal government is trying to insist that exporters from the end of this month must sell their money to the IE window. And what does that do to us? Exporters will either find a way to run counter to that rule, or they stop exporting, or they find something dubious to do. Because I can't bring my money after sweating in my farm to sell money to you at 380 or thereabout when I know I'm buying things at 470 in the market. It's a no-no. And
Now,
it's a major issue in this economy that must be dealt with.
Looking at the currency as it is, do you think it's undervalued? Or what do you think should be the fair value for the naira?
Whether you want to devalue or not, it must on its own depreciate. There are two different things. Devalue is when you do it deliberately to be able to drive exports and manage the challenges you have in your FX system. But when you don't do that, market pressures will continue to allow, get that currency depreciate. We had got to the level of 506.7. In fact, even before now, some years back, 2016, we got to more than 500. And there we were again, few weeks back before the oil price. This country is a highly risky economy, a monocultural economy. We are heavily, dependent on oil. And we must de-risk this economy away from oil. And until we do, we'll keep seeing this polongo dance, in that currency. And the only way out is that now we're having a better accretion. Let's build our war chest. And for once, just like Egypt did, normalize this rate. So people cannot be buying a currency at 370 in an economy where people are also buying it at 470. It doesn't make sense. Somebody must find an orthodox way to get it at 370 and next second sell it at the market. And that way you can never achieve sanity in that market.
Now that brings to question. I mean, looking at all of these issues, how much of every problem can the monetary policy really solve? Yeah. So what kind of synergy?
I have become almost an ambassador of central bank to say that the central bank is exhausted. And that's why I can assure you that as long as things remain the way they are, they will keep doing this sit-down-the-look MPC decision. Next month again, they will not do anything. Because what would they do that will count? So the Central Bank of Nigeria needs strong help from the fiscal authorities. And they've even said that by themselves. Some years back, some 2-3 years back, the Central Bank on their own, under this MFLA, said we have got exhausted. We're going to our limit. That's what they called monetary policy exhaustion. We can't do anything anymore. Because we're trying to solve, even Central Bank has become a fiscal authority. They're giving long-term loans now. Anchor borrowing, these are things that should be done by Ministry of Agriculture, Ministry of Finance, and find a way to provide grants and all of that. But thank God that we still have a Central Bank that can intervene.
If you listen to the governor, he was actually calling on the fiscal authority to help.
They are tired. They can't do anything anymore. Because Nigeria's inflation, like I told you, has gone beyond Central Bank. If they like, they can increase rate or bring it down. Inflation will continue to occur as long as we cannot provide enough FX to buy the things that we mostly import in this economy.
Thank you very much, Mr. Orji Udemezue, for your time. It's always a pleasure talking to you.
Yeah, always my pleasure. This is our own way to contribute to this economy as best as we can.
Please do come again, because I'm going to invite you again. All right, perhaps just before we get to Didion, let's again take a quick look at what's making headlines. Of course, the International Monetary Fund has raised its global economic growth projection for 2021. And this is coming a day after the United Nations released a similar positive forecast in its World Economic Situation and Prospects report. In its latest World Economic Outlook, the IMF put global growth estimate for the year at 5.5%, which is slightly higher than the 5.2% it forecast made in October last year. However, the International Financial Institution warns that the world economy may continue to face exceptional uncertainty, as close to 90 million people are likely to fall below the extreme poverty this year. Okay, let's look at what happened at the market yesterday. Eddie, well, the MPC ended yesterday, but that announcement was made before market closed. But is there any link to what we saw yesterday at the market?
Good morning, Chimi. Well, I don't think, what happened in the market yesterday had anything to do with the MPC. In fact, we saw the big boys in the telco industry come to the market, and that drove the all-share index up by 1.21% to 41,584.94 points, while the equity cap was at 21.753 trillion naira. Now, you would remember that Airtel Africa, we've been seeing gains in that stock recently, but yesterday the gains were really high. We also had gains from MTN Nigeria. Now, activity level was high yesterday. We saw higher volume, value, and deals traded, while the sectors were mostly positive, except for the banking and oil and gas sectors, which declined. But let's talk to Kayode Olayemi, a stockbroker at CSL Securities. Hello, Kayode. Good morning. Thank you for joining us on the program.
Hello, good morning. Thanks for having me.
Well, let's just start with your reaction to the MPC's decision. Was that in line with your expectations?
Yeah, the MPC was very much in line with expectations. In all with status quo. The meeting held, but I think the committee chose to focus on supporting short-term growth, while sort of push down the inflation pressure issues until further later in the year when the economy starts to pick up, and then we can now focus on.
Well, telecom stocks drove the market yesterday. Airtel rose for a second consecutive day, and then we also saw gains from MTN Nigeria. Now, does that have, is that all, just in line with investors positioning themselves ahead of dividend payout, or is there more?
With Airtel, Airtel is because the liquidity is very low. Stock has a very pension funds that are buy and hold investors. So usually, when investors are sort of looking for the stock, that sort of drives up the price. And that's what we've been seeing in recent weeks. If you look at the price on London and compare to the price in Lagos, the Lagos price is about over 100% premium. So what we're seeing here is just basically seeing liquidity in the name. I should note that they report their 9-month numbers on Friday, and as at 6 months, their EPS was down about 52%, so we don't really expect any. It's pretty much the same thing. The liquidity is quite thin, so when institutional...
All right, so I think the network doesn't agree with us today, but thank you, Kayode, for your input on the program. Do enjoy the rest of the day. Well, Jimmy, speaking about numbers, earnings season is in full swing. We saw results from Okumo Oil, Flour Mills, Julius Berger, and some, and I'm expecting to see, more in the market today. So we're likely going to see investors, just feel and rush into the market to take advantage of whatever gains they can make this season. But, we hope that these positive sentiments continue. Right now, the telcos are driving the markets. Let's see what happens today. It may just be the industrial goods or the banking sectors, because that sector, the banking sector, has been down. We've seen a lot of profit takers in that sector. So we may just see some bargain hunters coming in, which may drive stocks up on that counter.
Really, I would be surprised if the market doesn't go up today, particularly with the decision by the Monetary Policy Committee to keep the rates unchanged, because that is expected by everyone. And that, of course, is pushing attention again to the capital market. But let's wait and see what happens eventually. This market can really be some dynamism about this market is somehow. Anyway, we take a quick break, and then when we come back, we check with London. Just stay with us.
And for updates from London, let's talk to Juliana now. Hello, Juliana. Good morning.
Good morning,
Thank you for joining us. So the IMF has downgraded its forecast for UK growth, but sees global recovery forecast as stronger. I guess the projection is better than expected.
Well, better than expected globally, which I suppose is a good thing. But of course, domestically, this is not great, especially if you couple it with the data we've received over the past couple of weeks. Yesterday, unemployment for the 3 months to November stood at 5%, which of course we're looking in the rearview mirror because we're in late January, so we know that unemployment is much higher than that. We've also had the public sector PMI forensic look showing that we are in fact heading for a double dip recession. And then yesterday we got this further blow by the IMF, who have downgraded their projection for Britain's 2021 recovery. It had previously stood at 5.6%. They're now pointing it at 4.9%, which again, given what we heard last year by the World Bank, by the OECD, and even by the IMF, Britain is going to be coming out of this COVID-19 pandemic as one of the worst battered economies. It's not great. We are a service-based economy. And of course, services are shut down. We've got this third national lockdown. There doesn't appear to be an end in sight as to when we can emerge from this lockdown, particularly because, you know, even though if you read the British media, a lot of people are complaining at how badly the government have handled this. We've got 100,000 deaths at the moment. We are doing pretty well with the inoculation. Almost 7 million people have been inoculated, and because they want to protect this jabbing system, they don't want to start opening borders and lifting restrictions just yet, which does mean that there is going to be more economic turmoil in the short term.
Looking at housing now, private rents in some of UK's biggest centres have fallen by up to 12% in a year, but have risen sharply in parts of northern England. What are you hearing about this?
It's an interesting story, actually, especially, Laddie, anytime you want to come to London, if you've got a few pounds in your pocket, you may be able to bag a decent property in central London, albeit at 12% lower than you would have paid this time last year. And I think this is just really a sign of the times. Central London, pretty glamorous. This is exactly where the studio here in London is based. And a lot of people that rent here are people who have travelled here for short to long-term residencies. Of course, they're not coming here at the moment, so the asking price has really dipped. But what Rightmove are also telling us is that just in the suburbs outside of London, prices are rising slightly, and I think that's because there's been a complete culture shift for people living and working in London. A lot of people now have decided that they don't want, you know, the rough and tough and the rat race of London. They want to live outside. So as people are moving out, prices out are going up, and as people are not coming in, prices in are going down.
Interesting. Meanwhile, the HSBC Bank has been accused of taking a political stance over China's crackdown on Hong Kong. However, HSBC boss rejects the criticism. What's the latest on that?
This is an interesting story. Yesterday, top executives from HSBC were being grilled by a group of cross-party MPs at the Foreign Select Committee. And they've basically been accused of showing favour to Beijing authorities. Jacob Rees-Mogg, who's the leader of the House of Commons, has said that HSBC has more allegiance to Beijing than it does to Her Majesty. And that's a massive problem for Britain, especially because Hong Kong was a former colony of Britain, and they have been keeping a very close eye on all of these new draconian national security laws that Beijing have imposed on Hong Kong citizens. And I think the issue came last year when a top exec at HSBC publicly agreed or pledged his allegiance to Beijing authorities with these new national security laws. Since that time, we know a lot of activists, prominent activists who do business here in the UK but are supporting the freedoms that Hong Kong citizens are crying for. Their accounts have been blocked. The British government are really not happy about that, which is why they decided to bring HSBC in front of them. And even though the details are a little bit sketchy about what exactly was discussed yesterday, British MPs are still not happy that HSBC has a clear conscience and is acting ethically with regards to how it's treating some pretty high-profile anti-Beijing activists who are banking with HSBC in the country.
Interesting. Anyway, we'll see how that pans out. Thank you for the update and do enjoy the rest of your day.
Thank you.
And for the debt and currency market, Eddie is back on board.
Thank you, Ladi. I'm kicking this segment right off with Chioma Udu, a fixed income dealer at GT Bank. Good morning, Chioma. Thank you for joining us on the program.
Good morning, Eddie. Thank you for having me.
Well, the MPC decided to, retain all rates yesterday, although that was in line with most people's expectations. There are also some people who thought that the MPC will lose in rates. Now, what side of the coin did you fall on, and what did you make of their decision?
Well, the side of the coin I fell on was that they're going to maintain the rates and all the indices. But however, if you listen closely to the governor, he's all about growth and stimulation of the economy. He said he's going to keep the interest rate at 5% for a while. And, well, my expectations were truly met, from the MPC meeting yesterday.
Well, that decision determines a lot in the market, well, at least till the next rate-setting meeting. So what do you think we'll be seeing in the market?
Well, for the decision, I think we'll take a cue from what is going to happen at the NCB auction today. We have an NCB auction, the primary auction, where 187 billion is offered across 3 tenors. And we expect rates to trend up because there's been a bearish trend across the yield curve. This is mainly because of the illiquidity in the system. There's a liquidity strain from last week as a result of the statutory debit for funding of retail and auction bond settlements. As a result of that, we saw a sell-off. This is going to practically drive what the outcome of NCB rates are going to be today.
Well, you're talking about the NTB market. What's your outlook for the bond market, at least for the rest of the week?
Well, the bond market is going to be quiet with some bullish buyers. We have coupon payments coming in, and we expect that investors will try and invest. We also expect that the market is going to trade. There's going to be a mixed market trading after the NCB options.
All right, Chioma, thank you for your input on the program. Do enjoy the rest of the day. Chioma Udu is a fixed income dealer at GT Bank. Well, the bond market was bearish yesterday as we still saw yields increase in that segment of the market, especially on the long and short end of the curve. While the mid segment was flat, we had 27 deals worth 10.92 billion naira. The Nigerian Treasury bills market, on the other hand, was quiet, as investors were paying attention to what would happen at the MPC meeting. The CBN special bills market, there was no trades on that counter, while the OMO market was also bearish yesterday. We had 7 deals worth 19.29 billion naira. So, Chimi, well, that is on the market review.
Okay, so we'll keep an eye on that auction today. So, Ladi, anything interesting in the crypto market?
Bitcoin's still stable.
Everything seems flat.
It's quite flat, but some altcoins are giving gains here and there, but it's still quite quiet. Yeah.
Okay, that's it on the program for today. Thank you for watching. I'm Chimize Obi Iwagu.
And I'm Ladi Williams. Do enjoy the rest of your day.